I'm Yutaka Watanabe, a tax accountant. This is the channel, Tax Accountant Nabe solves your money problems. This time, I will talk about tax audit of corporations engaged in overseas transactions. For everyone developing business globally, today I will cover a term you absolutely cannot ignore. How and why does the National Tax Agency monitor cross-border transactions and movement of funds so strictly? Today, I will organize the overall picture as clearly as possible and explain it in an easy-to-understand way. For companies advancing global expansion, this is no longer someone else's problem. Let's clarify the actual situation right away. First, let's begin with this phrase that gets straight to the heart of the matter. One of the priority issues. Yes, the National Tax Agency does not consider tax audit of corporations engaged in overseas transactions to be just routine work or merely one item among many on a checklist. It clearly positions them as a top-level priority. In other words, this is a fairly strong message to companies. We are pouring in overwhelming resources and watching very seriously. There is no doubt that this stance will become even stronger going forward. Now, here is today's agenda. First, the National Tax Agency's priority issue. Second, deviation in transfer pricing. Third, measures against tax havens. Fourth, gaps in tax systems. And finally, the strict monitoring system. So that you are not overwhelmed by technical terms, I will carefully organize, step by step, the red flags that the National Tax Agency is looking at. Section 1. The National Tax Agency's priority issue. There are mainly three specific targets that the National Tax Agency has locked onto as priority issues. They are transfer pricing, measures against tax havens, and tax avoidance using difference in tax systems. These are not separate and unrelated problems. They are closely connected as a series of risks that tend to arise when global companies try to reduce their tax burden. From here, I will dig into each one carefully. Section 2. Deviation in transfer pricing. This is the first red flag. The tax auditor's perspective is very simple and very severe. On one side, there is the transaction price between related parties, such as an overseas subsidiary. On the other side, there is the price that would apply if the transaction were conducted between completely unrelated third parties, that is, independent companies. They are weighing these two against each other. What they are looking for is precisely the deviation between these two prices. In other words, an unnatural gap. This is where the transfer pricing tax system comes in. It is a framework for strictly checking whether related party transaction price deviate from arm's length price. just because the parties are related. Are they trading at an unfairly low or high price and intentionally shifting profit overseas? This can be called an extremely powerful filter designed to ensure that such deviations are never overlooked. Tax auditors use extensive database and comparative analysis tools to thoroughly identify pricing gaps. Section 3. Measures against tax havens. What you need to be careful about here is that the National Tax Agency is not simply looking vaguely at whether a tax haven is being used. What they are watching closely is omission of application of rules. They are trying to find out whether rules that should originally be applied have been completely missed, whether intentionally or accidentally. That is why this definition becomes extremely important. The tax haven countermeasure tax system is not merely a penalty. It is a system designed to prevent this kind of omission in application. As long as the rule exists, I did not know is not an acceptable excuse. It is a mechanism for completely closing these loopholes. Section 4. Gaps in tax systems. The connection between cause and effect here is very straightforward. When a company takes action by using differences among countries' tax systems, the National Tax Agency's auditors immediately see it as an alert for tax avoidance. Using gaps in international rules may look at first glance like a clever tax-saving technique. However, from the auditor's perspective, it is nothing more than an avoidance act that must be checked strictly. Since the OECD's BEPS action plan, information sharing among tax authorities in various countries has been advancing rapidly, and the monitoring net is becoming thinner and thinner. Section 5. Strict monitoring system. Let's summarize the surrounding net we have discussed so far. This is the most important point I want to convey today. Unnatural deviations in transfer pricing, omissions in the application of tax haven rules, and tax avoidance using gaps in tax systems. All of these, without exception, are strictly checked. No matter how complex a scheme is developed overseas, it is important to clearly recognize the fact that it is not so easy to slip through the sharp eyes of National Tax Agency's monitoring system. Finally, I'd like to pose the ultimate question to everyone. Can your company's overseas transaction truly withstand this strict screening by the National Tax Agency? Are these any deviations from arm's length prices? All these are omissions in the application of rules. When you compare these points with your own business again, unexpected vulnerabilities that you had not noticed before may come into view. Discover risk early and work with specialists to take countermeasures. Please use this as a hint for your future risk management. This time, I spoke under the title Tax audit of corporations engaged in overseas transactions. For information about tax audit, please also visit page of Yutaka Watanabe, Tax Audit, Tax Accountant Office. I will continue to talk about topics related to money, so please subscribe to the channel. Tax Accountant Nabe solves your money problems.